Hi guys, it's Imran Larka from Options Insight. This is the second video in my tutorial series where I showcase the exciting new crypto options exchange called Delta Exchange. In my last video, I was talking about trading Solana options and trading call options in particular, which gave me some exposure to some upside in Solana because I thought we could get a bit of a bounce in price after the market had sold off quite aggressively. In this video, now that we've had a bounce, I'll be discussing put options and particularly, using put options to protect your crypto holdings. First, let's take a look at the charts. Okay, so here I've got the Ethereum chart. And you can see that, I've got various lines marked up on here, but I was using, before the market kind of crashed, I was using 2,900 as an area of support, that kind of 2,900 to 2,800 area, the kind of coincidence of these two green lines. When we broke below that, that support was negated. We kind of went all the way down to around 2,150. And now as we've recovered, we can see that that area is kind of acting now as our first resistance, okay? So I would expect on the first test of this area, there to be some resistance, and we're probably going to fail at this area and maybe go back down at least to 2,400 or maybe even retest that 22 and beyond. Okay, in terms of the bigger picture, I wouldn't be surprised for this big picture correction to actually go as far as 1,750 in Ethereum. That's what I'm looking for. So I want to be protected in the case that that scenario is going to happen. Now, if this level breaks, we could probably push up to this downtrend here that I've drawn out, which could get us as far as maybe 3150 in Ethereum, at which point I think that would probably fail, as at least at the first test. Okay. So given that I managed to, get some bullish trades on or unwind some protection when the market had that move down, now I'm looking to add back some protection onto the portfolio. Okay. And I'm looking at potential downside plays in Ethereum. Okay. Now let's look at the exchange to discuss, the type of put options that might make sense to trade. So here we are with the Delta Exchange platform again. We can see, if I bring up Ethereum options, the reason why I'm actually interested in buying Ethereum options as well as my protection trade is because Ethereum vol is actually trading quite cheap. Now, the way you can kind of ascertain that is by looking at some volatility analytics. So you can see here, I've got the term structure, which tells me the implied vol for different maturity options on Ethereum. And we've got a very sort of upward sloping pink curve here. A week ago, it was just what that blue dotted line is. So it was quite flat. So you had 80 implied vol across most maturities. As you've seen over the last week, that vol has collapsed. So we've got the 11th of February, the 18th of February, all those maturity options down at 67 implied vol, which for Ethereum is amazingly cheap, right? And the way you can show that that's cheap is you just compare it to what the realized vol is. So you can see that the realized volatility, if we look at this chart on Ethereum, the realized volatility has got as high as 120 recently, and it has come down a bit to only be around 80 right now, 82. But that is still significantly higher than implied volatility, which is, in the expiries that I was showing in the 1 to 2 week maturity is in the mid 60s. Okay. So that's how we can ascertain that whether vol is cheap or expensive versus how much the asset's actually moving around. Okay. So we've established that Ethereum vol is trading quite low, quite cheap, quite good value. So now let's look at some put options to maybe protect and protect us to the downside and see what those look like. So if I go back to the exchange, the Delta Exchange platform, we've got Ethereum here. We can pick our expiries. I'm kind of looking at something like the 18th of February, give myself a couple of weeks, because I think if we do get a down leg, it may not materialize immediately. It might take a week to happen. So by buying the 2 week put, I give myself a bit of time. And then if I look at the kind of pricing of the options to see what we've got, we can see the at the money options, which are around this 2,900 area. They cost around about, the 2,800 puts cost $140. Okay. which might be a bit more than I want to spend. I want to get something with a bit lower premium and a bit more leverage. The delta of those puts is 44%. So maybe if I push that strike down to 2,500, then, you know, that's a 20 delta put. Okay, so it still gives me some downside exposure, but it only cost me $50 or $53, something like that. So that's the type of option that if we do get a move down to 2,600 on Ethereum, which is a couple of hundred points, and that happens in the space of a few days, that option will probably go from 50 to 150 pretty quick. So that could triple in value quite easily. Okay. Now, if we go to the strategy builder, we can see the payoff of that put. We can see the P&L profile of that put in more detail. Okay. So if I bring up this here, and I basically choose the put we're talking about, which is this one, and I say I'm going to buy that, then I go to my payoff. Okay, so now you can see I've got the 14-day expiry, 25 puts on Ethereum in my strategy builder. So this is telling me what the payoff profile is going to look like. So we can see here, I switch off all the other options, then we're left with just this one here. And, you know, the blue dotted line shows us the payoff profile of the put option. Okay. If the market stays above the strike, anywhere above 2,500 at expiry, we're going to lose our premium, which in this case was around $50. And if we start to go below that strike, it's going to start to make money, right? So that blue dotted line shows us what the profile looks like of the put option at expiry. But if we look at if we want to know what it looks like today, then obviously we take the expiry to now, as in we take it, the time is actually now, we're not going forward in time. And you can see the blue dotted curve. That's what our put option value is really going to act like, right? And you can see as time passes, that collapses itself into the expiry payoff, which is that hockey stick payoff that we talked about, okay, in the previous episode. So anyway, that's what the put option looks like. If we look at the Greeks, we can see the delta is minus 20%. We can see the theta bleed is about $5 a day. The option costs around $50. So it makes sense, you know, we're bleeding about $5 of that per day, waiting for that move to happen. And it's got a little bit of positive Vega exposure on it because it's got that implied volatility exposure, right? If that implied volatility, which is currently, you know, around mid 60s, if that goes up, what happens to the value of my option? You can see volatility going up by 30, 40, 50 points would increase the value of my option, whatever happens to the spot price, because that implied vol exposure is what we call Vega exposure, right? If that vol drops back down to where we are, you can see we're back to that starting blue curve. And then if the vol actually drops and goes even lower, you can see that the option value starts to drop. Similar to if the passage of time, as we get closer to expiry, the value drops. That's a very similar effect to when the volatility is dropping, when the implied vol is dropping. It's kind of like the option is getting closer to expiry, right? Because implied vol dropping is just another way of the market saying, we don't expect this asset to move very much, okay? Anyway, so that's what an outright put looks like. And that's kind of one of the potential trades that you could be doing for protection. Okay. Now, if you didn't like the fact that it was only 2 weeks to expiry, then you might want to go longer dated. Okay, so that would be one obvious way to change this. So if I get rid of that and instead I pick an option maybe with the longest maturity available, and we look at something like the June. So what put option could I buy in June? So you've got maybe the 2,500s again, right? We'll have a look at that and see what that's worth. Well, that's actually worth a hell of a lot. That's worth about $360. So you can see the pricing of that option is not cheap anymore, right? The 2-week option only cost me $50 for the 2,500 strike. But the one that expires in June, which is 140 days out, that option is costing me $370 odd, right? Which is pretty much more than 7 times what the 2-week put is costing me. Now that obviously the payoff profile of that's going to look very similar. It's just that the expiry is going to be different. Okay, so you can see here we've got the payoff profile here, and Same story, right? We bring that closer to expiry, it drops, we take it back to now. It's that curve profile. Okay. Now the good thing about these longer dated options is the theta bill on them is less, right? Whereas the 2-week option was costing me $5 a day in time decay, the theta on this option is only 1.75. The Vega, on the other hand, of the option is $6, okay, which means I'm much more exposed to what the implied volatility does in June, okay? And if we go back to that original chart on volatility and have a look at what the June volatility looks like, well, it's not as cheap as the front end, right? The front end volatility is at 65, but the June volatility is at 83, which means that if nothing happens for a few months, that June volatility could drop and roll down this curve and go to 65, and that would lose 20 points of volatility, right? Which on a Vega exposure of $6 per vol point, that would cost me about $120, right? Of an option that's worth $370, I would lose $120 just in Vega P&L because the vol has dropped by 20 points. Add on top of that the time decay that's passing every day, and this option can start to look quite expensive. Okay. So anyway, that's kind of what that looks like. Now let's assume you didn't want to pay 370. What could you do? Well, a common strategy for protection when you don't want to pay up too much and you think the vol's quite elevated is we sell another option against that to turn that into a put spread. Okay. So whereas we may have bought this 2,500 strike put, what could we sell against it? Well, we could sell maybe the 2,000 put against it, or say we wanted a bit more protection, we could sell the 1,500 put against it. So if we assume we sold that one, then that would get us 70 points back. So rather than spending 370, we'd only spend 300 because we get 70 back from selling that lower put. Okay. If we go to the payoff chart, what do we see? Well, we see what a put spread looks like. So the put spread makes money. The put makes money below the one that we bought, makes money below 2,500. And then as we get up, as we get all the way to 1,500, that's when our protection stops. Okay. So we basically only make money between 2,500 and 1,500. So we make 1,000 points, but that's the most we can make. And we spent $300 to do that, right? To have that exposure. Now, what are the benefits of selling out that other put? Well, let's have a look at the Greeks, right? The Greeks are, we can see the delta is still negative. It's around 22, 23. So we've reduced the amount of delta we've got. So that means the structure is going to make less money than the put by itself, but it's still got some negative on it. It's still providing us some protection. If we then go to the other Greeks, that's where we see a more dramatic impact. Okay. So if we switch off that sale, you can see the old theta bill was 175 and the Vega was 6. Now we've got a theta bill that's only 0.9 and we've got a Vega of 3.6. So we've taken the theta and the Vega roughly down by a half. Okay. So by doing that structure, by selling that lower strike put, we are managing our carry and we are reducing our Vega risk, right? And that is called a put spread. We are trading a protective put spread on Ethereum because we need some money coming our way if Ethereum goes down, but we want to manage the time decay. We want to manage our exposure to implied volatility. And the way we're doing that is by selling the lower strike put, the 1,500 strike put against being long the 2,500 strike put. Okay. So that's called a put spread. So we've got protective puts, we've got put spreads, and then there's various other structures that you could use. You could sell some call options if you wanted to fund that. If you said, well, it's still too expensive at 300. What do I want to do? I want to sell some calls to get some premium back. This is against my crypto portfolio, so I can afford to sell some calls because I own Ethereum anyway. I don't mind selling some of my Ethereum out at a higher price. That's what selling calls does, right? Selling calls is basically saying, I don't mind getting rid of some of my exposure if the market rallies by a certain amount, okay? In this case, assume we pick the highest strike available, which is the 5,500 on Ethereum. So Ethereum goes from here, where it is roughly 2,800. It goes from here to 5,500. That's basically a double. right? Ethereum would need to double between now and June to get to 5,500. How likely do we think that is? Probably not that likely, most people would say. So then maybe you're comfortable selling that call option. If you sell that call option, that will receive you about $100. And now you spent $300 on the put spread, but you're getting $100 back from selling the calls, which means now you're only spending 200. Okay. I've added that strike on there. If we go back to the payoff, what do we see? Now the payoff structure looks like this. We've got the put spread making money on the downside and capping itself out below 1,500. But on the upside, we start to lose money above 5,500. So that's called a put spread collar structure. Okay. If you look at the Greeks, what's quite interesting about the Greeks is we've now sold another option. We sold that call option, which means our time decay has actually become positive. We will actually receive money through having this structure on our book, because in the short term, at least, we'll receive money. We know that we still did net spend $200 on the whole structure. But for now, the theta, which is every day that goes by, the value of this structure is actually increasing for us, right? Because we've net sold more options than we've bought. Okay. We can also see that in the Vega exposure, which has gone down to a negative 0.78. So we've gone from a positive Vega to a negative Vega, which means now we are actually short volatility. We will benefit from implied volatility going down. And then the last point to note on this put spread collar is the delta. The delta of the put spread collar is quite large. It's a negative 0.395, so approximately 40% delta. So this is kind of like a more aggressive structure that's willing to reduce your delta exposure against your crypto holdings, to reduce that exposure by more, because you're giving up the upside by selling calls, but you're keeping your theta bill down, you're keeping your Vega exposure down, even slightly negative, but you've got a big, heavy delta on this put spread collar. So if the market does drop, you'll be well protected. You'll be nicely protected, because this structure will go up in value significantly, and that will counteract the losses that you're taking on your crypto holdings. Okay, that is me giving you some examples of put protection strategies that you could be putting on Delta Exchange, on Ethereum, if you're a bit nervous about this crypto market like I am. Thanks for listening, and see you on the next tutorial.